I remember when we first met, you're like mind mapping business processes, and I'm just like, you're so dang technical.
Like, why is it a big argument and a fight over this is better than that's better than this is better? How about no? Adjusting your behavior is better. Looking at something that's simple, easy to understand, and efficient that doesn't require a lot of thought process so that you can focus on what really matters, which is your family, and investing in yourself so that you can earn more revenue, so that you have a way to control more of the revenue that you do earn and keep everything else dead simple. I mean, like, that just makes a lot of sense.
It's impossible to be efficient if you don't have that desired result, and so many people don't even know where they want to go.
It's not potentially, it is extremely misleading. There's no potentially in it.
Break this down and tell me where I'm going wrong.
Like, if you've got family members and you're not protecting your family, I can just be perfectly blunt with you. I think that that's insane and really stupid. What do you want to choose?
Richard, I don't think I've ever done this on a podcast to someone like you. The last thing that you said, this drives me nuts when I hear this. We were 25 minutes into one of the most authentic conversations talking about issues that our audience would totally eat up. So stay tuned, because some of the things that we talked about will be talked about in the future. We talked about the Infinite Banking Institute, what some of the things that you're working on. We talked about some of the things that people are getting wrong in talking about infinite banking. You literally, in your newest book, which we'll talk about, have chapter 8, where you go over all the misleading things that people are saying. I shouldn't say all, some of the misleading things that people are saying using infinite banking. I love the fact that you touch on that, because most people don't want to touch on that, because most people sell or create a brand around those things. So definitely want to talk about that. And you're also one of my favorite Canadians. And so, we want to be able to talk to the people up north. And I know that infinite banking, the philosophy, and we're going to get into it, nothing changes, but maybe how you implement some of the insurance products is a little bit different. And so I don't know where this conversation will go, but I just want to thank you for being on, and I'm graveful that we get to have this conversation.
Yeah, man, I'm excited. It's been, I think it's probably long overdue. Sometimes scheduling can be a bit of a challenge. Having a podcast myself and having all the content and calendar management. So thank God we have incredible assistants that help navigate all that. They're the most amazing human beings on the planet. And so very grateful to have incredible who's to help us get the hows done, as Dan Sullivan would say.
I love it. So your book, Don't Spread the Wealth. How many books have you actually written today?
This is book 4. We started with Canadian's Guide to Wealth Building Without Risk. We're actually going to be re-releasing that, making some modifications to it to turn that into an American's Guide book. We have Cash Follows the Leader, which is really about the mechanics of dividend paying whole life policy and what actually makes it grow. And it's not what people really think or realize. We have some great visualizations in there. The third book is Keep Taxes Away from Your Wealth. That one's much more focused on the Canadian market. Henry Wong, who's a CPA and works on our team, he co-wrote that book with us. Some great stories in there and trying to get the control back. I mean, fundamentally, all of these things are about getting the control back at the you and me level. And each book is independent. It's not like one necessarily builds on the other. And one thing I'd want people to know is our books aren't meant to replace, as an example, the AND asset. They're not meant to replace becoming your own banker. They're meant as a complement to, and maybe providing a different way or context on how to actually view those things, how to comprehend them at a different level, so that you can, when you still go through the other content, you might see things that maybe you didn't see before. So it's meant to add flavor and context, right? It's a little salt and pepper on the main meal.
I remember the epiphany that I had when I was like, oh, I'm going to bring on other competitors that say things different than I do. And oh, by the way, we've grown our business because I bring on people like you that write books that are fantastic, that have different ways of explaining things. You resonate with some people, you bring exposure to some people that would never get exposure to this space. And we all grow because of it. And there's a lot I could talk about as it relates to that, but I want to get back to your book. In one of the first chapters, you answer the question, what is infinite banking? How would you answer that on this podcast if someone was to ask you, Richard, explain to me, what is infinite banking?
Well, you can't place limitations on something that's infinite. Finite has limitations too. So the infinite is the infinite capacity of the human brain to come up with ideas and generate, or your ability to generate. It's your thinking. That's what the infinite really is to me. Banking is an action word. It's something that you do. Banking transpires. It happens throughout your life every single day. Money has to move from one place to another in a relatively short period of time. That's what Nelson Nash would indicate. That is the activity, the action of banking. It is a process of money movement from a location to a location at some measure of speed. This is happening every day in everyone's lives. Infinite banking is thinking about that activity in such a way where you're putting yourself in the control position as often and as frequently as possible as it relates to your individual needs or your business's needs or the needs of the family members you love and care about. That to me is what the infinite banking concept is. Concept is a modifier, what Nelson say. It's about a thinking process. It's something that is an idea that you conceptualize. People make concept cars. Every car that's driving on the road today was at one time a concept. And there's a lot of concept cars that don't get into production activity, right? But the concept of what it is often displayed, and it gives you a vision or a thought process on what could be. So the infinite banking concept is exactly that, but it's around the mindset. And so it has virtually nothing to do with life insurance. It is 100%, in my opinion, about what's going on between this squishy mass of your ears, this thing you call the human brain, and how you relate to the information that flows through your life around the financial aspect and the movement of money. Using an insurance product to help accomplish that objective the way you want to do it in some form of efficiency is simply making it a logical decision. So the separation between a product, life insurance, and a process of what you do things and how you think about doing those things. There's a thinking aspect, and then there's a doing. Thinking, doing. Product. You're thinking, you implement a product, and you do activity as the doing. That's now putting all those components at work. But you can't have an insurance product that you own and be doing infinite banking. It doesn't work like that. You have to actually be recognizing the function of banking in your life and trying to recover some of those control elements slowly and incrementally as you build, so that you can see the benefits of having that the decision-making potential at your fingertips.
Yeah, I want to unpack that, because I know my channel and many other people, you could easily think, okay, infinite banking is a properly designed insurance product. That's very much a lot of marketing, and a lot of people combine those things. And I could not agree more with what you're saying. Is having an amazing insurance product is great, but it doesn't necessarily make or break how you think and what you're doing. For example, and I might go on a mini rant here, some people come to me and they'll ask me, Caleb, what should I invest in? And I look at them and they're making 20% of what they could be making. And it's always funny to me where it's like, you're asking me if I should do a Roth or this, and we could go down that rabbit hole and you could get the right answer, but the real question should be, why are you making this when you could be making that? So it's changing the way you think about how you produce. Another question is debt good or bad? Well, or should I use debt for something? And it's really going to being like, okay, what decision are you making to begin with? Debt can be an enabler. Debt might enable you to buy a home that you shouldn't buy, or a car that you shouldn't buy. But the way is like, let's figure out how you should make that decision. And then we go back to what's the most efficient way to make that decision. But a lot of times people combine them into one, but they really need to be separated. With all that said, let's talk about the thinking aspect and then the doing aspect without talking about insurance. You're in Canada. Some of the things that you do in Canada can't even be done in the US, vice versa. We'll talk about the insurance in a second. But I really want to break down okay, if I got my paper and pen out and I want to take down the steps, help me understand the questions, the prompts, how I should be thinking, what I should be doing with no product. And then we'll talk about why maybe insurance could be better than any other product as of the time of this recording.
I think it really boils down to getting either clear or making the recognition. If someone chooses to do that, again, this is all about choice. And Nelson, in my opinion, in his wisdom, he isolated the power of human choice and then incorporated it in financial aspects. So if you think about other great financial books, one of what really well-known book is The Richest Man in Babylon.
Love it.
Okay. And people are often met or learn about this idea of, oh, you got to pay yourself first. Pay yourself 10%. Like we've all heard these kind of adages before, but no one actually really fundamentally understands how to do that or what does that really mean. So that's a great statement, but what does that mean and how would I go about doing that? They think, oh, well, I'm going to put money into a savings account, put 10% away, or I'm going to put money into an investment account and put 10% away. And then what ends up happening is people don't put 10% away, or they don't put it in one of those accounts, or they put it in the account and then they take it out and use it and there's nothing left in the account. Like that's what actually happens for most people. So here, if we start incorporating the mindsets and we recognize that the problem is that someone is performing the function of banking in your life. Money must reside somewhere. Money comes in, money goes out. That's everybody's life. In between the period of it coming in and going out, it sits in some kind of a holding tank for a period of time. Most likely a typical brick and mortar bank's bank account, okay? Or a variety of them in general. Well, how much of that do you retain control over? And for how many years of your life are you retaining that control? And how many generations can you retain that control for? So the question of, are you thinking beyond your own lifespan comes up to me. That's something that Nelson caused me to think about a great deal. And I was having a conversation about this early this morning. I was doing a bit of a presentation to a group of 25 highly successful entrepreneurs in a networking group. And I was asking them these type of questions. So how many times are you thinking beyond your own lifespan? Very few people even consider that as a possibility. But once you recognize it's possible with your thinking, now you start to think, okay, well, going from today moving forward, if I recognize that every decision I'm making around financial aspects of my life actually extends beyond my own lifespan, is there anything I could do or anything I might consider changing in my life that might optimize for that outcome? And if that's an outcome you want, well, then now you can start taking initiative steps toward that. So do you want it? Do you understand it's possible? Like, again, everything ties to what your brain is willing to comprehend as a possibility. And if you start asking different questions and you're thinking about your thinking, you might come up with some very surprising answers within your own mind that you didn't know were there. It's not what Richard's mind can profess to you, okay? It's what question is going to resonate inside of your own mind. It's going to get you to think differently. And for me, I didn't realize it was possible to think beyond my own lifespan until I met Nelson. Nelson taught me that it was absolutely possible. I'll give you an example, Caleb. Nelson, okay, you got a lot of real estate investors listening to the show, right? Probability? Okay, cool. I've got my song and dance stories about real estate. We won't go into that, but here's the example. Imagine for a moment, for your listeners, you've got 45 doors, 45 properties, all right? All 45 of these properties, well, it could be 2 apartment buildings with 45 doors. Like, I don't care the dynamic. 45 single-family houses. They're all 100% paid for. You own them free and clear. They're growing with equity every day, regardless of the market condition. They can produce a cash flow. And if you needed access to capital, you can borrow 90% of the equity on every single property with no questions asked, and the money could be in your bank account within a couple of reasonable days. You don't have to fill out any Mickey Mouse paperwork. You don't need to go and pay for an appraisal. You can get access to that liquidity on very short, circumstances. Now, we're going to talk about you in the past tense, Caleb. You're no longer with us. You've graduated. 17 of those 45 properties are instantly sold on the market for their highest ever appraised value. You don't need a realtor. You don't need to wait for the market condition. You don't need to kick out the tenants. They're instantly sold, and a tax-free amount of money with no capital gains tax shows up for your wife and your family. There's still 28 properties in place that now are under the control of your family, and they continue to have all the same benefits. You need more money, they have access. They're still growing in equity. All those same things apply. Well, that actually can happen. In fact, it did happen. It happened to Nelson Nash. But it wasn't physical pieces of real estate, but it was property. Property through the way of contract, insurance contracts. We think about property, the brain pictures a box and a house or physical land because that's how we've been trained to think about it. And that is real estate property, but property exists in contracts as well. And whole life insurance contracts are property. And so Nelson had 45 of those. And when he passed away, there were 17 death benefit checks paid. There's 26 policies that were still in force when Nelson was gone. He left us at the time of this recording. We're approaching 6 years since Nelson's been with us. In that time frame, unfortunately, we also lost his wife, Mary, semi-recently in the last year. So a number of those contracts have transpired again. I don't know that number, but just to keep things simple, let's say that there was 10 more that are gone and there's 16 policies still left in force. That transitional effect of what transpired is evidence of Nelson thinking beyond his own lifespan. Okay? And so you can do that. Now, Nelson, you know the story. It took him 13 years to fire his bankers. But after that point in time, him and his wife did not see a traditional bank for approximately 25 years, other than the convenience of a debit card. Okay? And they financed all the cars. They financed 3 airplanes while Nelson was alive using the system, in investments in real estate, a number of other things. And they had control over that circumstance. And very simply, what that meant to them is that it was a peaceful, stress-free way of life financially. That's one of his objectives. That's something that he wanted and he created in his life. If you don't want that, this probably wouldn't be a good process for you. If you want a lot of risk and a lot of reward and a lot of potential chaos and a lot of sleepless night, at the time of this recording, we just had the election. So if you want to be sitting here wondering, oh my God, what's going to happen at the end of the election? Or my portfolio is going to go down 30% or is it going to go up? Oh my God. If you want to live on the roller coaster, by all means do that. But you might want to consider de-risking some of your thought process financially to create stability and consistency that is always going to be there, so that when you want to make those decisions, you can be empowered to make them at the right timing and at some measure of control.
I love it. Richard, I don't think I've ever done this on a podcast to someone like you, but I'm going to share my screen and I'm going to walk through how I would teach somebody, and I want to get your raw feedback. And then I would love if you can share your screen if you'd like, because I hear what you say about the banking function and all those things. They all sound amazing. I was talking to Brent Kessler the other day, and we were talking about infinite banking, and I was just like, Brent, you literally just said you went to the seminar and you were saving 0, and now you're saving $4,000 a month. I'm just making up that number. I was like, no, duh. You literally changed your thinking.
That's going to move the dial financially in your life.
Yeah, and you started saving, and you stopped spending. So you stopped spending, you started saving, and voila, you paid off your debt. And so what I want to say is, I love there's nothing magical about the insurance aspect. It's you change the direction of your money.
Changed.
You know what I'm saying? And so it's and again, I said that publicly, so it's not I love Brennan. He's an amazing person to speak to. I'm going to have him back on because a ton of comments were Caleb, you have to have Brent break down the math because I don't fully get it. And that's why I'm actually doing this with you here, because you have an amazing understanding of philosophical conversation, but you're also one of the most practical. I mean, I remember when we first met, you're mind mapping business processes, and I'm just you're so dang technical that it's good stuff. So let me walk through quickly the process that I would walk someone through if I were to help coach them around money, and let's talk through it. So number one, let's see here. Number one, you got you, and for those of you listening, I'm drawing a stick figure. That's one of the only things I can draw, and we can all agree that
it's a very well laid out stick figure.
It's a very skinny. This stick figure needs to gain some weight. But the first aspect, and it might sound wishy-washy, but it's you got to get really clear on what you really want. I have a sign behind me, one life. It's we all have one life. Let's live it well. Let's live intentionally. To live intentionally, you need to lean into the skill sets that God gave you, and the relationships, and use your resources. And I love it. You have to take full responsibility of your life. And one of the things that many people have said, nothing that I'm saying is my original idea, is you are your greatest asset. That really resonates with me, and I find that majority of people in Canada and in the United States are devaluing their greatest asset, which is themselves. So one of the things, regardless of what you call yourself, is like we could be doing the best thing for our clients if we help them identify where they want to go. It's impossible to be efficient if you don't have that desired result, and so many people don't even know where they want to go. So that's number one. Then what I'm doing, for those of you that are listening, is I'm drawing a dollar sign. And this dollar sign represents the creation of cash, the creation of currency. I don't even want to call it cash, because cash is a store of value. Currency is what we're using today. You guys spend a different currency in Canada, but at the end of the day, currency is not just created out of thin air. Well, maybe it is, but you get what I'm saying. It's like to create extra cash flow, I need to do something for it. I either need to provide a service or sell a product or a version of both. And so it's like we could have a conversation all day long about the dollar size. Some clients that we have make a ton of dollars. Some people that we work with are on a super limited situation because they don't make that much money. But it's not all. You have to create cash flow. We could talk till we're blue in the face, but if you don't have any new cash flow into the system, you can arrange chairs on the Titanic, but the Titanic's sinking if no cash flow is coming in. Okay. Now here's the key. So now you have cash flow. I'm drawing two lines. Line number one is consumption. Line number two is I'll use the word saving because it's a verb of preserving. Okay. So saving and consumption. Okay. Now, again, this is very much inspired by David Anderson, a good friend of mine who has a software program called Live, and so the lifetime income process. And so the philosophy here is your dollars can physically only do one of two things. They can either be spent, and consumption, another way to say it is lifestyle, or they can be saved, set aside for future consumption, whether it's you or 3 generations from now. Okay. And so consumption could be, spending. It could be taxes, because if you don't pay your taxes, you're going to jail. It could be debt. It could be like anything that any cash flow that's going towards your lifestyle. Okay. And then saving is set aside. And then the idea is to multiply. It's to save, and then hopefully you're investing, and you can invest in businesses, you can invest in the stocks, you can invest in real estate. You could invest in making yourself more valuable, so education, all those things. And hopefully not only are you potentially growing your cash here, but you could be creating a double effect and creating more money because you're investing in your business, and your business allows you to create more cash flow. Are we tracking so far?
Yep.
Okay. So let's just break it down. The average American's probably spending 95% on consumption. They're only saving 5% maybe. And then with this money, their money is diversified so much that they're not making any difference. And so one of the things that, like, from a coaching perspective, it's like, number one, are you clear on what you want? And like, I know you're certified in many different assessments. Help them identify, like, are we maximizing the cash flow that we're creating? And then looking at 2 of the fundamental buckets. Where's your money consuming? Are you spending money on the things that you value? You might be spending your money on dumb stuff. Are you overpaying on your taxes? Where's your money going, and really creating an audit of that? And we might find that, like, we're consuming at a level that we just can't outdo. But then where we're saving, this is where, and again, I don't want to put words in your mouth, but how I've always explained the infinite banking process, especially with using life insurance, is like, okay, we can save our money, and we can then, you can use your savings account to pay off debt, do other things, and then pay yourself back. So you can do this whole, like, volume of savings in an account, but over time you have a savings account that has an interest rate, so it gives you certain benefits, but there's trade-offs. And long term, life insurance, when set up and used properly, gives you so many more benefits to your dollar, which is one of your myths, and we agree, but it's like if you can give your dollars more utility, you can give your dollars potentially 5 or 10 jobs versus one, now I could potentially save more. And one of my theories of why people aren't saving a ton is they're saving, they're investing in things that they're not liquid. And so it's like, yeah, I'm only going to save 5%. I'm almost hedging. I know I'm talking a lot, but like the way that I almost talk about this whole concept is insurance is this aspect here. It's in between the verb of saving and the where your money's going. And our goal should be to save more. Like you're literally like, you should save a lot more than 5%. And so can you save 10, 15, 20, 25, 30%? And the goal is always to save more money. Like that's the metric I care about. I don't necessarily get into the weeds of like paying yourself back interest, like, because I find that at the end of the day, what we're doing is we're just saving more. And so we're using a lot of different words for like, let's increase our ability to save, and good things happen. Going back to the Brent Kessler conversation, good things happen when you go from saving nothing to figuring out a way to save $4,000 a month. Using insurance on top of that long-term is going to be better for your legacy and for your cash. But even if you didn't have that, like your life is different if you have the ability to save a lot. I just talked a ton on a conversation that you should be talking, but I value, like, break this down and tell me where I'm going wrong, or let's talk about what you agree and the differences, because I think this could be super valuable to this conversation.
Yeah. I mean, fundamentally, I wouldn't say there's anything I disagree with, Caleb. What I would want to clarify, or it would be to add additional context. Okay. Context is really important. So a couple of things. Yes, saving more is good. If anyone thinks that saving more is bad, they A, will never find themselves on your podcast, and B, they probably have a lot of other problems they need to be dealing with. Okay. So if anyone disagrees that more saving
No,
is
if
bad,
you disagree, let me know, and I'll set up a conversation between you and we'll have amazing content at your expense.
Totally. So where there needs to be a distinction, and I'm glad you clarified, you used saving as a verb, saving in the action-oriented aspect.
Yep.
You know, where I'll add some context is we used to do presentations to groups, man, all the time. I mean, for years we did it. And probably, if I add it all up, I bet you over 1,000 people I've asked this question to over the span of like 7 or 8 or 9 years in Canada. But, you know, Canadians and Americans are basically the same, except there's a border in the way and we have some more snow. If you know, what does savings mean to you? And then we would go to the board and write it all down. We'd take everything that everyone said and we write it all down. And then we'd say, okay, great. Now, what does investing mean to you? And we would write all those things down. And the themes were ridiculously common for the better part of a decade. Savings, fundamentally, after everyone's responses, isolated that you had control, liquidity, and you had, it represented security. It represented security for people. Investment represented risk and reward, the potential for more and the potential for loss. It was synonymous with the word investing. Okay? Nobody put down that investing meant security unless it was right. You can buy a security, which is a product. Does that make sense?
Correct. Yeah, okay. Yeah, which is super confusing, by the way, but yes.
So fundamentally, those two activities and those two
different.
Product dynamics, if we're looking at it in a product format, are fundamentally very different. All right.
Correct. And the epiphany that I had years ago, going back to the book I wrote, The And Asset, was insurance is not an investment. Huge mistake that people are making when they try to compare it. But it's just a better place to save, protect, use, and pass on wealth. It's like a better container.
Yeah, it can be when you have the right behaviors in place, right?
Correct.
So going back to your diagram, you have the word savings and you're looking at it from the action. It's the movement part of the money. So that movement doesn't happen without the decision. So prior to the savings action is the behavior to commit to the savings. So that's what's missing from the diagram. And then now you've got multiple other lines. You've got, okay, now the business and the stocks and real estate. So those are all now a secondary decision.
Correct.
Now, now that you've done the act of saving and you've placed it somewhere, now what do I want to do with it once it's there? So it could go back to the consumption, it could go back to pay off debt, it could go to the business, but you're not saving in the business. You're investing in the business. You're investing in the stocks. You're investing in the real estate. You're making it an investment decision that you'd rather pay off your debt rather than doing something else with the money. So
Correct.
What we're looking at is a multi-tiered decision-making process.
Yes.
The process of becoming your own banker is around the decision-making process. Okay? We're making decisions, micro decisions along the way about what to do. And you talked about interest and paying yourself interest. Yeah, big fan of that. That's what Nelson taught us to do. But fundamentally, the reality of that, the result of those activities results in is more savings activity.
Correct.
So you're taking the loop of committing savings, then you're putting it to work someplace, repaying your debt as an example. I'm going to get rid of third-party Visa. And I was happily going to give Visa, maybe not happily, but I was giving Visa $500 a month. That's what they wanted as a minimum, but I was paying them $1,000. Well, if I'm happy to give Visa $1,000 a month, wouldn't I be happy to give my family members at least $1,000 a month? Who do I value more? Do I value Visa more or my next generation? Which one do I place a higher value on? And if the decision process is I place a higher value on my family, I should at least be willing to pay at minimum what I was willing to give Visa. So now $1,000 a month comes back to your bucket. It repays the policy loan, or it builds up policy value, or it builds up a savings account, whatever that is. But the action of making the decision, that's behavior-based, okay? That has nothing to do with an insurance contract or a savings account. It's all around the decision-making process. This is where banking that's where the rubber hits the road. The result of that is more capital gets accumulated because less capital is going away. Less goes away and more gets accumulated. And the result is, psychologically, the brain starts making different decisions about money. You see things building up where they weren't before. You also do see a decrease most likely in consumption because you're placing a higher value on things that you previously didn't place value on.
Well, and if you're redirecting money back to your checking account or insurance policy, regardless of where it is, you're creating a greater volume on the savings category. Like the example I could use, let's use the $1,000 Visa. Okay, route number one is doing what you just said. You use your banking process, pay that off, but then you pay your banking process back. Okay, or what you could do is instead of directing that money into the savings category, take that money that would be residing in the banking policy, pay off that Visa, and then redirect that $1,000 that you were paying Visa back to savings. Either way, you're making a decision ongoing to not spend $1,000 on the dumb thing that you may have been buying. So it's like it's not just the magical checking account or insurance policy. You're actually deciding to consume, in this example, $1,000 less in your lifestyle in this example. You can't have your cake and eat. Like, you can't continue the same lifestyle choice and have an additional $1,000 of magical money.
There's no magic pill. There's no circumventing the fact that you need to do the work and that you need to make change. And
I love it.
Nelson had just created a methodology that is extremely logical about how to implement behavioral change. Again, being an Austrian economist, understanding the Austrian mindset of thinking, there's a great book called, Human Action. I can tell you and confess, I've not read the whole book. I've read pieces of it. But Human Action and really Austrian mindset of economics is around the behavioral aspects of individuals and how individual behavior impacts broader economic cycles, okay? Fundamentally, if I were to put it into like a little bow. And so infinite banking as a concept, when implemented through the utilization of dividend-paying whole life insurance, which is the recommended path, is fundamentally considered Austrian economics in action at the individual level. So why does that matter? And so we go back to savings. And so people aren't necessarily accustomed to savings if they haven't been doing it. There's a training process, a learning process, and a habit change that must happen. One of the best ways to implement that is to create a forced need. Insurance premiums, once implemented, becomes an automatic pay yourself first, in air quotes. I'm being very aggressive on the air quotes here. Pay yourself implementation of the same idea of the richest man in Babylon.
Yes.
And so now what we're doing is we're implementing really good, fundamental, basic financial principles of saving more money, and we're creating a forced mechanism that makes you do it so that you don't make dumb decisions otherwise.
Hey, it's Caleb Williams here. I'm just interrupting this video quickly to invite you to check out our And Asset Vault. You may have been there. We've actually revamping it. And if you are somebody that wants to learn more about, is life insurance the right fit for me? Does this And Asset make sense? Like, does this actually help me be more efficient? We've put together a 10-minute documentary style video that I think does a really, really good job giving the history, why the And Asset, different setups and designs that we use. And then we have an And Asset Vault that gives like case studies, calculators, handbooks, and so much more. We are here to serve you, whether it's a conversation, whether it's education, or the video. So make sure to go check out andasset.com/vault to learn more. I'm so grateful that we're having this conversation because you're 100% spot on. And I don't know if you realize how close you sound to Dave Ramsey. And I actually say that as a compliment. I love, like, Dave Ramsey and some of the things that he said.
First time for everything.
Yeah. No, I love what Dave Ramsey, like, the mission that man's on and what he's, like, I agree with what he talks about in insurance? No. But he was just on a podcast recently. And he said this because it wasn't a person that was trying to like grill him. They agreed on some ideologically deals. And he said, yeah, the 15-year mortgage, like I get the whole argument, but the reason the 15-year mortgage is better is people won't invest the difference. It's like the reason why we tell people to be debt free is the human aspect. The reason we get someone to cut up our credit cards is obviously if you use a credit card and pay that off, the points and all those things, like obviously that's going to be better than a debit card. But the reality is there's something different. Like most people don't do that. And so it's like we have to stick in our lane. And the same thing that goes with infinite banking is like it's not necessarily magical. In some cases, it might be less efficient from a mathematical standpoint. But actually it's better for you and your family because you're creating a system that's creating momentum. And the same thing that Dave Ramsey could say is like, over 30 years, the people that follow this advice are going to be better off because they're forcing themselves to actually save more. Because the reality is 30-year mortgage invested difference is just not going to happen. So I'm letting you know, like tell me where I'm wrong, but it's like the human aspect is something that you can't necessarily model in a calculator. And it's far more important than anything because we don't live our life unemotionally. Even the most nerd people out there don't make every single decision based on the mathematical opportunity cost of every decision. Like we just don't do that. And so thoughts, would you agree with my assessment or disagree with that?
Here's where I think you need to recognize what a chainsaw has to do with the infinite banking concept. Okay. Have you ever used a chainsaw, Caleb?
I have. Yeah. Yeah.
Okay.
Believe it or not, people might think I'm crazy. Yeah, but I have.
Was it battery operated or was it gas powered?
It was gas operated.
Okay. So you can almost instantly remember the smell of what it smells like when you fire it up.
Yes.
And the sound that it makes when the chain moves and you hit the trigger?
Yes. Okay.
People who've used a chainsaw really understand that sound. This is one of my favorite things. I love chainsaws. I don't know what it is. I used to use them a lot. I don't have one now. I have no need for a chainsaw, but I just think they're fantastic tools. Okay, and they're fun to use. When you fire it up and you rev that thing, and it's like, oh my God, like there's something really, this is a dangerous tool, but there's really cool things you can do with it. It's a very powerful tool for the right job. So just imagine for a moment, I had the chainsaw. It's got the oil mix, the chains oiled, everything's ready to go. Fire it up, give it a couple, let it run a little, rip a few times. And then all of a sudden, I just hand it to some dude that's running by on the street on the path. And I say, hey, buddy,
not good.
Here you go, knock your socks off, and I turn around and I walk away.
Yeah.
What's the probability, low, medium, or high, that person might injure themselves?
I 100% probability that person's not going to be optimized.
Yeah.
It's
probably medium to high. And what's the probability that they might break the chainsaw? Also reasonably high.
Yeah.
Okay.
Yeah.
And so, because, there's some intuitive aspects, but it's not, it's pretty dangerous when you're using them. And so the tool wasn't the problem. It wasn't the tool's fault. It's 100% the user's fault and the lack of training of the user or practice of the user. And so if that tool, let's just say that tool was dividend paying whole life insurance.
Yep.
But we could replace that and say, what if that tool was buy term invest the difference as a combo tool?
Yeah.
Does that make sense?
Yeah.
It's the exact same difference. I don't care what the strategy is. The strategy is irrelevant if we don't have the behavioral alignment.
I agree.
If you want to buy term and invest the difference, knock your freaking socks off, but do it. If you're not going to do it and you're going to buy term and spend the difference, you destroyed all the good spreadsheets that somebody ran for you. A spreadsheet can't run your financial life. A spreadsheet is a static document that's not dynamic. Your life is dynamic. Your behavior is dynamic. The things that happen to you, the economy is dynamic. Interest rates are dynamic. Real estate markets are dynamic. Your health is dynamic, and the people you love and care about is dynamic. If you're not preparing for those things in a logical way, you are, in my opinion, giving up the opportunity and also abdicating the responsibility. It's not just the opportunity, it's the responsibility. And if you're not willing to get really clear mentally on why that's important, like if you've got family members and you're not protecting your family, I can just be perfectly blunt with you. I think that that's insane and really stupid. I'm not calling you stupid directly. I think the act of not doing that is stupid. So when are you going to make some change? I'll give one more step forward on this. I can give two more things. So Caleb,
and I could talk to you all day, man. I love this. Yeah,
I'm sure in the experience of doing this, you've had people become that are uninsurable. You haven't been able to help place insurance contracts. How does that feel when that comes up with your team?
Yeah, it's terrible.
It's absolutely terrible. It feels like I can feel it in the pit of my stomach. I absolutely despise it, and it's really frustrating. When it happens when it's a kid, have you ever had it happen with kids, minors?
No, I have not.
I have. In fact, it's happening more frequently. And one of the reasons it's happening more frequently is because of behavioral adjustments. A lot of kids are having behavioral issues, and now everyone's got ADHD in their son. Now, nothing wrong with that. I'm sure if I was diagnosed, I probably got it, and that's fine. But it doesn't mean that you can't get coverage. It just means that might complicate getting coverage to some degree. Every insurance carrier is different. Every circumstance is different. All right. So, but I'm starting to see an increasing trend of that. And when that happens and I have to go tell a parent that we can't insure their kid, that's like a knife in the stomach, man. I hate that. It's frustrating. And I've had people, and I've even heard people say, well, why would you insure your children? Well, first of all, they're coming from a place of non-understanding and not realizing that there's dangers. If you look in Nelson's book, there's a mortality chart on here. CSO table, I don't know what page it's on. It's like 30 something, whatever. And it shows Nelson called it the pig and the python. So for your listeners, there's a little diagram right here you can see. And if you look at this chart, it says, out of 1,000 Americans, would you believe it, 1,000 of them die?
Yeah.
But the line that die before age 21 is an astronomical number. In fact, it's the longest line of all of the lines in the chart. So the number of child-related mortality, deaths, and things that occur is an astronomical number, and so too is it for things like critical illness and whatever. So to not prevent against that risk, seems really strange to me. And nobody knows what their best before date is, but they also don't know what their best insurability date is.
Yeah, it's good.
There's only one way to find out, and that's to go apply for some freaking coverage. So protecting your family fundamentally to me is just a logical step. If you can also do it in such a way where you created a forced savings plan that allowed you access and control over someone else's money, the insurance companies, not yours, because your money is now a premium, but your ability to access capital is unmatched and untapped than any other financial product that exists in the marketplace on the globe that I'm aware of. Now, I might be wrong, but no one's been able to prove to me that there's a better mechanism that allows you unlimited access to whatever you have equity inside of a contract of without any questions asked. No one's been able to show me something better than what a dividend paying whole life insurance product will provide. So that is a characteristic of a tool. And if you are stack ranking characteristics of tools that you can implement, like the chainsaw, if your goal is to cut down the tree, hey, I could use a drywall saw. I could use my pocket knife. I could use an axe. I could use a bobcat to knock it down probably, but it would be illogical and I would need to go get one. But the most efficient tool in a lot of circumstances is a chainsaw for the average everyday person. So what do you want to choose? Like, why is it a big argument and a fight over this is better than that's better than this is better? How about no? Adjusting your behavior is better. Looking at something that's simple, easy to understand, and efficient that doesn't require a lot of thought process so that you can focus on what really matters, which is your family and investing in yourself so that you can earn more revenue, so that you have a way to control more of the revenue that you do earn.
Yeah.
And keep everything else dead simple. I mean, like, that just makes a lot of sense.
Well, where do I? Yeah, yes, 100% agree. You would agree with me that if we're solely focused, and I'm sure it drives you nuts, if you're solely focused on cash arbitrage, money growing, borrowing against it, paying yourself back.
How quickly can I get money into this thing and take all the money out so that I can put my money at risk? How quickly can I make my money safe and then take money and put it at risk again?
But I've even said this, like, and if you hear me out, let me finish my thought process. It's like, I've even said, if all I cared about was a place to store my money and use it, I think there's better vehicles than insurance. Thought crime. Okay. And when you understand the other benefits, like a death benefit that increases, accelerated death benefit riders, some of the greatest tax benefits in Canada and the United States. That's one thing that we have on you guys a little bit more. But like, when you start understanding the benefits, I have a video that might be on YouTube at the time of this recording, is the 11 multi-dimensional benefits of insurance. When you start valuing other things, there's no other asset that I think holds a candle to, properly designed, dividend-paying whole life insurance product as a place to store, use, protect, grow your wealth. But you have to, in my opinion, you have to value other things. You have to at least be open to the other benefits. And in my experience, if someone just cares about cash arbitrage, they tend to be the worst clients, and they tend to not value what we're doing, because all they care about is, in year 26, I'm going to be arbitraging my money. And the reality is, you could be, but it's the only reason why you're doing it. There's probably better ways to just arbitrage your money if that's all you care about. And so, if you understand the value of giving $1 more than one job, which in your book you say $1 doing more than 2 jobs is misleading. I think I know what you mean. They're talking about borrowing. I want to talk about that. But the way that I explain it is like an iPhone versus a flip phone. I have a phone, but this gives me a lot more jobs. It's my alarm clock. It's my white noise machine. It's my map. It's my phone. It's like I can text I do a lot of utility on this. To call this a phone versus a flip phone, I guess it's accurate, but this gives me a lot more uses. The way I see life insurance is, it's just, there's no other asset that holds a candle to it if you value the other benefits. If we're not going to talk about the other benefits that it does to your financial life, then I think we're doing this a misservice. You want to talk about what I just said, and then if we got to wrap this up shortly, but I want to go through the 5 myths. And you do have, in chapter 8, you say $1 doing more than one job is simply misleading. I actually agree with you, but someone could hear what I'm saying and then hear that and say they contradict each other.
Yeah, and I think, we want as human beings to try to simplify information in such a way where there's a reception to where people are at, okay? And so we use analogies sometimes because we hope it makes things simple to get people to like, oh, I think I kind of understand what you mean by that. But, when you pay a premium, and you're transferring ownership of that money to the insurance company. It's now the insurance company's, and it's provided a benefit to you. The benefit is the contract that protects your family. And that contract now has a host of other things that you can do with it, which is what you're identifying. So the other jobs or the other possible things that contract can do is what people allude to as the other jobs. Oh, I transferred $1 here, and now I have a death benefit. But because I have that death benefit, I can also now do these other things. But if you really get clear on it, what's actually happening is I pay a premium. Premium creates a death benefit. Once the death benefit is established and the contract is accumulating according to its contractual features, you can now do other things which would be akin or similar in nature. You could make a case to say, well, isn't it sort of like I can do other jobs? Well, not really. My dollar did one job, which is pay for a premium. Once I have the policy...
Which by the way, by paying for the premium, you get a lot of utility.
You get utility just
but
in that one thing.
Your dollar's not physically in two places.
Correct. Your dollar is a premium. It's done. Now what you're working with, or what you can work with, is the contract and the contract features and the utility, which is the insurance, with the relationship between you and the insurance company. So your dollar isn't doing more than one job. Your dollar is doing one job, but that one job just so happens to coincidentally create utility. So in that, I would agree with you, but to shortchange it and say, well, isn't that just like saying it does more than one job? No, it's not, because what happens is you're misleading the reality of what's taking place, and you're disconnecting the importance of the premium. That's fundamentally what we're talking about. And one of the things we cover in the book is the idea of rags to rags in 3 generations. That's what's happening with people consistently. And so if we're not talking about ways to have good communications in the household with money, we will never break that cycle. And that's really important. And one of the things that comes up, we talked about these behaviors. Money doesn't ruin, it reveals. Also something we talk about.
That's so good.
And so if you don't have a relationship with money and you're not developing or building a relationship, just like you're dating and you're courting your spouse, you got to build a relationship. You got to get to know one another. Well, if you have a really crappy relationship with money, don't you need to start dating money and maybe see if you can fix your relationship? Maybe you need some marriage counseling with money. Well, that's where guys like Caleb comes in to help with that part of it, okay? That's the thing that we're trying to create in the world around us. And I believe that our book helps do that, and I certainly know that Nelson's book does that.
Yeah, I love it. I love it, man. It's appreciate you fleshing that out, and I really believe these conversations that go deeper than maybe the average podcast, I think have so much value that can give to the coach, the advisor that's listening to this, but also the consumer. If you're listening to this and really want to grasp like different wealth strategies, like it's how you think, and a lot of our conversation is around thinking tools. I know you're a big fan of this, around how we approach different opportunities. And so I love that. The first myth is you can't buy an infinite banking policy. I think we talked about that. There's a difference between a policy and a process. And just because you're buying a specially designed policy doesn't mean that you're practicing infinite banking. And it doesn't necessarily mean that your behavior could be worse off by you getting a policy, but you're not changing anything else, and as a result you're putting too much stake in this insurance policy that's like a chainsaw that's in the hands of someone that doesn't know how to utilize it.
It's even worse than that, Caleb, because life insurance companies make insurance products. They don't make banking products. And the general public and the consumer hears someone on YouTube or whatever telling them that they can go get A, B, and C, and they don't understand the disconnect because, wow, that A, B, and C you talked about sounds really good. I'm going to go contact the insurance company and get me one of those. Or better yet, I'm going to get one from you, and then I have questions about it. And because maybe that advisor is not explaining things very well, they contact the life company directly. And they say, hey, life company, I want to talk to you about my infinite banking, right? Well, that doesn't exist. You can't buy that. It's not on their product list, okay? And by the way, when they get those phone calls, they go straight to the legal department. And then the legal department stacks those up in a big folder.
They're like, money laundering what?
Until they have enough of them. And then they say, hey, all the advisors that are promoting these things, we're going to end your contracts and pull them, and you can't service your clients anymore. Okay? So using language irresponsibly is exactly that. It's an irresponsible use of language. We're trying to clarify these things because everyone can do better, including me. And certainly I'm sure you would agree with that, Caleb. And so we help people get, if they want, a whole life insurance policy or other insurance that they might need. We then teach them a process, which is how they can utilize their money and the capital with that policy to do things in their life they're already doing. That is the process of becoming your own banker, not the product. A product is whole life insurance, period. Complete separation. Don't mix them ever together. It's not a cake that you're baking with ingredients. It doesn't exist.
Yeah. Well said.
Sorry, a little
third
soapbox moment there. You can see I get a little agitated with that.
Just due to time, I want to get through these quick. Think about premiums as deposits. The truth, premiums are payments, not deposits.
Yeah. Again, an oversimplification. And I've used this myself in the past a lot. And some people will say premium deposits, or some people will just say deposits, because deposits is a banking activity and it's easy for people to understand. But by oversimplifying, we're also disconnecting the importance and the value of what a premium actually is. Once you pay a premium, it does a job. And now you're not making a deposit with the insurance company, because that also means that you could get the money back out. That's not what it is. You're paying for something, a product, you're paying for it. It's now a payment. It's done. You get all these benefits. If you want to access capital, you take a policy loan, which is completely disconnected from the deposit. The deposit in a banking institution assumes that it's sitting on deposit, you can ask for it back. That is not the case with the insurance company. It is not a deposit. It is a payment. You're paying premium, you're getting benefit for doing that.
One of the potential issues is Nelson wrote his book, and he never for once was like, hey, I want people to leverage this to sell a ton of insurance. Like he was thinking more about the process and talking about this. And then when you start marrying some of these concepts with insurance and then regulation and all, I've met people that don't even know they have an insurance policy.
Oh yeah.
They're like, and I'm sure it makes everybody look bad. And it's like, okay, what are we doing here? And it's because sometimes we use that language, and that's where regulators are like, this is unacceptable, and it is. It's like, that's where I'll agree with the regulator. You won't hear me say that much on this show, by the way. Number 4, saving at 4%, borrowing at 6%, coming out ahead. The truth, this is misleading. Love the fact that you have this. I've seen presentations, I'm sure that you've had examples, and why is this misleading?
I've done presentations like that in the past, and not the purpose is to shock people to understand how amortizations work and how the impact of a loan balance going down and an account value going up. It's misleading because it's shock therapy and it's not really clarifying what's going on. And the reality is, it's just to help people see things differently, to start thinking differently. That's the purpose of an example like that. But people will walk away, they'll take a little bit of information and they'll jump to an absurd conclusion. That's what happens all the time in society. And so this isn't about, it's to show the impact of having money in constant motion. And if you can maintain constant motion and have capital accumulating in a format where it can't be stopped, it can't be turned off or go backwards, and you have the ability to access it to go do other things, you maintain a high level of control. But the example where those kinds of things are displayed misleads people to think that, oh wow, everything I know about percentages and math is completely incorrect. Wow, I can make 4% and pay 6% and be fine. Because if you just do that willy-nilly, no, you're going to create unbelievable financial chaos. It is, so people will take a little bit of information and jump to a certain conclusion. That's why it's misleading.
Yep, and it's two things can be true at the same time. We just talked about a system and being like changing your behavior, and there's a world where you could justify earning 4%, paying 6%, and actually being ahead because you're changing the cash flow situation. And the same thing can be true that earning 4%, paying 6%, mathematically, if you add apples to apples comparison, never gets you ahead. So there's like a mathematical aspect, incorrect. There's another aspect where it's like, hey, we're changing behavior. Yes, mathematically, we know that this is not the most efficient, but over the next 20, 30 years, I got someone to start saving more money, and by default, saving more money, they're better off. And that's where it's like, not everything can be so black and white, but I'm glad that you make this distinction, because we're all guilty of this.
It also doesn't account for interest rate risk. It also doesn't account for behavioral risk.
Right.
So we're looking at a spreadsheet of numbers over a period of time where your life doesn't work that way. I'm sorry, life is too dynamic to make any of that work. It just might look good on a spreadsheet, but it won't actually most likely come about in the way that's described, because something's going to get in the way of your life. If your life is anything like mine, some stuff's going to happen.
Last thing that I'll do, you have more here, and that's why everyone should go get your book. We'll make sure to have the Amazon link. Is that the best way for them to get it, or is there a better way for them to get this book?
Don'tSpreadWealth.com. Don'tSpreadWealth.com, and it'll take you right there.
Don'tSpreadWealth.com.
If it brings you to an Amazon.ca site, just change the .ca to .com, and it'll be easier to order.
Perfect. Just please, we need to be supporting the people in the space, and so you would be doing me a favor if you went out, supported Richard and Jason, who's not on here, who has the world's busiest schedule, but I'm going to have Jason on at another time. We're going to have great conversations. You guys co-authored this book. Encourage people to go get it. So last thing that you said, this drives me nuts when I hear this, is, and honestly I think should be number one, is getting rich by buying insert the thing. I can't tell you how many people, that's one of the reasons I just don't like to be associated anything with infinite banking sometimes, is it's just like, I got rich by buying a car that I can't afford. That's how I perceive it. It's like, you get rich by going on vacations, and there's like a lot of people that market, and they're literally showing you, they're the I don't want to say an inappropriate word. They're the person that's like the kid that's like taking a picture of their Lambo that they're renting and being like, look at me. And it's like, actually that behavior is making people worse off or distracting us about actually doing what we need to do. And we think we just need to buy expensive cars, but if we magically do it with an insurance policy, we're somehow going to be a millionaire. Obviously I'm venting, but talk to me about why that is potentially misleading in your own words.
Well, it's not potentially, it is extremely misleading. There's no potentially in it. It's just flat out misleading. And in fact, it's flat out wrong. So you cannot generate wealth through consumption. Consumption in a broader economic terms can generate wealth in an economy because it's turning the wheels of the economic machine. That's different. In your personal home economy system, it's just not possible. What happens for this is that people, again, take a little bit of information and they jump to an absurd conclusion. They see an example and they see how, wow, by following this behavioral process and also coupling it to a hopefully well-designed insurance policy, I can go acquire a item, as an example, a car that I need anyway. And if I make the payments appropriately and I follow through on exactly what I indicate, I'm going to have a capital reservoir that is matching or similar, or maybe even potentially greater than what I paid for that car later on. It doesn't mean that I didn't use money to pay the car. I did. Money came out and I paid the car dealer. The money's disappeared. But now I've recovered through behavior the same equivalent capital that would have went to someone else and gone forever because of poor behavioral habits inside of a containment facility. Just so happens to be an insurance contract. And because that containment facility was also growing at the same time through contractual elements that would have happened regardless of buying the car or not, you put those two things together and it seems like maybe I have more money than what I paid for the car. It's not really true, but you could say, okay, yeah, I have an account that is attached to an insurance policy that has more money than what I paid for this car. But that's not really what happened. And so people, they're misleading people to think that something grander is happening than what's happening. Again, this is all behavioral based. You don't solve the behavior, you have nothing. You have great insurance, hopefully, and your family's protected. Hope you have that. But if you don't have the behavior in place, you really aren't implementing anything. You're not implementing a process. You're not infinite banking anything.
Yep. Richard, last question, and then I'm on a deficit of time on this end. If I had a mortgage payment and my interest rate was 4%, let's just say, and my loan rate for an insurance contract was 6%, mathematically, we can agree that it does not make sense to borrow against my insurance contract to pay off 4% mortgage. But the reason I might do that is a conviction on getting the banks out of my life and how commercial banking is creating inflation in the world. And is that like, everyone can do their thing.
Yeah.
But is there an argument to say that, like, mathematically that would not be smart, but the reason people would do it is because they value other things like getting actual commercial banks out of their life.
So so to me, there's arguments for it that are definitely larger and grander than just the pure mathematical aspect. Mathematically, it's not part of a broader strategy, and if it's also not something you desire, like so if we go back to the psychological advantage of knowing that you're not beholden to some third party lender, and what does that create for additional value in your life mathematically, there's some sense to that. Would I agree that it makes sense for everyone? No, I really wouldn't. But as an example, like in Canada, we have 5-year mortgage terms generally. You guys have 15s and 30s, and it's just like
30s,
plain and simple.
Fixed.
In Canada, everyone renegotiates their mortgage interest rate typically on you can get a 1-year term, a 2-year, 3-year, 5-year. Most of the nation is on a 5-year term. So every 5 years, you're renegotiating or getting a new update on that. And the payment can change and payment can fluctuate. So if you've got a prepayment privilege of a certain amount and you say, look, I got access to capital, I'm in the first 5 years of that loan, I'm going to maintain liquidity, but I'm coming up for renewal. Now I'm going to take 40 grand and I'm going to drop it down on this loan. And now I'm going to renegotiate the loan terms and I'm going to spread out the amortization to a longer, and I'm going to drop the payment so I can increase cash flow. So now you have a logical basis to maybe make a situational occurrence that it might make sense for you given your other life scenario and goals, but also maybe not. So it really just depends. Is there any ability to recover cash flow in the situation that can benefit other areas of your life financially, where you're not placing all of your financial energy into a black hole of ABC Bank's mortgage pool that you can't get back out? If the goal is to pay off the mortgage and never tap into the equity of the property, but you're going to sacrifice doing things and give up all of your liquidity to make a decision that now if you need money, you can't get to it, that would be highly illogical to me. That's more of a liquidity decision and a logic based on giving yourself more options. I'm all about options, not taking options away.
Richard, I love talking to you. I would love to have you back on, talk about the difference between Canada and U.S. when it comes to insurance. I also would love to have you on to talk about what you're doing at the Nelson Nash Institute. You're a leader of leaders, and there's some very exciting things, and we can break down all the good, the bad, the ugly on the past, the present, and the future as it relates to all those topics. And again, thank you so much for coming on. I want to encourage everybody, go, we'll have the link down below. Anything else call to action-wise you give to us, we'll have the link down below. Any final words that you want to say?
The key thing I want people to know about this is we talk about family banking meetings and the importance of having them. And in fact, as a bonus you can download for free is a 15-page guide to creating and helping you design your own family banking meetings. It even has some sample exercises you can come up with as ideas to use for your kids. And if people don't even read the book and they just get that and begin implementing it, I think that I would encourage you to read the book, but I think you're going to get tremendous value, and you can start taking money conversations in the family and changing the environment that your family lives in around those discussions. And if we can do that, I believe we can make real generational impactful change regardless of whether you have an insurance policy or not.
Richard Canfield, thank you so much. We'll have all the links that you've mentioned down below, and I look forward to having you back on.
Thanks, brother. Appreciate you.